So another big question is, are we going to enter a recession or not? And as I mentioned before, consensus is we're going to sort of stick the landing, stick this soft landing where we don't feel much economic pain, economically in the United States. Maybe. And as I've said, I think when it comes to finance and economics, you've got to think probabilistically and not in absolutes. So I would put maybe some probability that is possible, but it would be unlike anything we've ever seen before. You look at sort of some of the key indicators that have preceded recessions in the past. The Conference Board has a set of leading economic indicators. Those have been negative, and not just for a little while. They've been negative now for 20 months. Other times where we've seen that, in the mid-'70s, we went 25 months. In the global financial crisis, for example, we went 24 months. So those are sort of big economic indicators that are commonly followed that are flashing, if not red, at least yellow. Another thing that you see is yield curve inversion. And again, the Fed funds rate is 5.5% and then sort of slopes down from there. And it's very restrictive monetary policy, and it tends to slow an economy. We're now approaching a year of an inverted yield curve. So again, it's possible, but this would be really the first time in recent history, called the last post-World War II era, that we've ever seen us skate past that, despite everything saying the opposite. One of the theories put forth is, well, we've been experiencing these rolling recessions, and I would say there's some truthiness in that. Certainly the housing sector was affected when mortgage rates spiked over 7%. You can look at manufacturing, you can look at services, and all of them, and now the goods economy is slowing, all those have experienced certain declines. But the idea that kind of in perfect harmony, a free operating economy, free functioning economy, is going to ebb and flow sector by sector such that we on balance always stay positive from a GDP standpoint, just seems impossible on the surface. And again, we've just never seen that before. And again, almost all economists and strategists seem anchored in that belief that that's going to happen. Mind you, these same economists and strategists were all lined up believing that we'd be in a recession last year. So again, just a healthy skepticism and even some degree of cynicism, I think, is helpful. What could push against that? I think the biggest surprise that people have tried to get their head around is the resilience of the U.S. consumer. And if there's one thing that we do really well in the United States, spend money. And of course, as we know, the government fiscally flooded consumers with cash, and people also during COVID couldn't do a whole lot of things, and so the savings rate actually increased. Well, that's not the case anymore. Everybody agrees that the savings rate has plummeted, and they're burning through cash, the consumer, at a pretty good clip. And so the cash is running out. And then if you look beyond that, it appears that a number of consumers have sort of already run out of cash. And if you look at things like outstanding revolving credit, you're seeing a big spike in that. If you look at even sort of some more dangerous tea leaves, you can look at serious credit card delinquency rates. Those are starting to move higher. So again, it appears to us that this resilient kind of super consumer that was built during COVID seems to be running out of gas. And I think another good metaphor to think about is kind of fiscally the government, putting its foot on the gas during COVID and now starting to let up. And at the same time, the Fed and monetary policy is slamming on the brake. And last year, that combination still yielded positive growth. But again, undeniably, the consumer's coming under pressure. The only other thing that could really keep the consumer afloat, I'll say, and strong, the job market still remains incredibly tight. But if you think about that, that also has a negative side to that coin, which is a really tight job market tends to also be inflationary. And think about wages and the pressure that puts on wages. So again, that sort of sets in motion this idea that maybe the Fed keeps the Fed funds rate higher which again leads to a greater likelihood that you're going to have a recession. Inflation clearly has started to move down. A big open question is moving from something like 9 to call it 4 or 3. Was that a lot easier than call it the last mile of getting it down to their 2% target? I think the answer to that's yes. Now, working in favor of inflation coming down is going to be rent or owner's equivalent rent. But this also has another side of the coin. Real estate developers, at their own admission, would say we always overdo it. And multifamily housing has certainly been an area that's been incredibly popular. We are going to deliver roughly 1 million multifamily units this year. That's a new record. So I mean, they're going for it and more. And while just simple supply demand economics, you've got an abundance of new supply hitting the market. Something that we worry about. Most of these projects are financed with debt, and so think about it. Doesn't take a rocket scientist to know that we have had inflation in materials. So whatever that pro forma was underwritten on a multifamily housing development, cost probably exceeded what was expected. And in terms of the sale, with interest rates up, the value of that property is less. So banks, just like they faced with the office sector in real estate, could have a problem on their hands. The other thing that, again, kind of worked for us, and again, this is the foot on the gas, is the government spent a lot of money last year. So if you look at its fiscal year, they spent $1.7 trillion in a single year deficit spending. So you just think about that. That's 6% of GDP, over 6% of GDP alone. Our total debt's a little over 30 trillion. So I mean, as you're adding debt to what already is a very large pile of it, you're quickly going to escalate. Even the Congressional Budget Office, which I think has a pretty good, fair-minded view of how things will play out, we're already at kind of roughly the highest levels we've been since the post-World War II period in 1946, where we were 106% of GDP. But we're in an expanding economy with no world war. This is a time when fiscally you should be running surpluses. And in fact, you'll recall we did, only 20, 25 years ago. But instead, we're running some of the biggest deficits we've ever had. And as interest rates normalize, one of the things to be looking at is just how much interest expense alone that the government has to pay starts to make up the budget, and it starts to crowd out the government's ability to make investments in research and technology and infrastructure and other things that we know drive GDP growth over time.